that we're seeing.
JPMorgan say prices as high as $10,000.
Yeah, exactly. Jamie Dimon.
And This is a major shift, and it sort of signals that we're probably going into the third and final phase of the bull market, which is the greatest gains in the shortest period of time, usually. The bull markets have three phases. The ratio between gold and silver took 14 ounces of silver to equal the value of 1 ounce of gold. 85 to 1, I think, is what it's at. And during COVID, it shot up to 120. Silver has never been that cheap compared to gold. And I do believe that you are absolutely going to see the gold-silver ratio at 20 or less. So that means silver's value rises compared to gold's.
Mike Maloney explains that the current setup in precious metals is entering what he calls the third and final phase of a long-term bull market. This stage historically delivers the most significant gains in the shortest period of time, with even major institutions like JPMorgan now projecting gold prices as high as $10,000 per ounce. The mainstream is finally acknowledging what sound money investors have long anticipated. Maloney highlights the extreme distortion in the gold-to-silver ratio, which recently hit 85 to 1 and even spiked to 120 during the pandemic, the most undervalued silver has ever been relative to gold. As this ratio normalizes toward 20 to 1 or lower, he believes silver will massively outperform gold in percentage terms, marking the explosive final leg of the metals bull cycle. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
They think they're taking pride, and the people that are selling are going to regret it one day. They really will. It is sad to see the East buying and the West selling, because it's a wealth transfer that is going on. And we are nowhere near the top of the precious metals markets. And the things that tell you that are things like the Dow gold ratio, the gold-silver ratio. In 1980, when gold and silver peaked on the same day, the ratio between gold and silver took 14 ounces of silver to equal the value of 1 ounce of gold. And that is about the natural ratio is that there's about 19 times more silver in the Earth's crust than there is gold. Silver tends to occur more up toward the surface, and gold is deeper. And so when we would dig it up back then, the reason that the gold-silver ratios averaged about 15 to 1, somewhere between 13 and 16 to 1 all over the planet, was simply because if you've got a certain number of coins in circulation, you got 13 of these silver coins for each one of these gold coins in circulation, it's the free market. Yeah. Finding this equilibrium, the exchange rate. And right now, at 85 to 1, I think is what it's at. And during COVID, it shot up to 120. Silver has never been that cheap compared to gold. And I do believe that you are absolutely going to see the gold-silver ratio at 20 or less. So that means silver's value rises compared to gold. Well, this is exactly what happened back in 1979. Silver lagged for the bull market of the 70s, and then just suddenly, when gold started becoming perceived as too expensive, and today, $400 doesn't sound too expensive. But you got to remember, before 1980, the average income in '79 was like $9,600 a year in the United States. And so gold had gone from $35 in less than 8 years, $35 to $400. And so the average guy, if he's in his 40s, $500 may have been the majority of his savings. I don't know. But he goes into the bank, takes out $500, rushes to a coin shop and says, I want to buy gold too, and they drop one coin in his hand. And at that point he goes, oh, is that all I can get? How much is the silver? And it's when the public changes their preference from gold to silver that, people blame the $50 silver price in 1980 on the Hunt brothers. Yeah. And it's absolutely not true. They added 50 to 75 cents at the most to that market. It was really the public changing their buying preference, silver being perceived as a better bargain.
That we're seeing.
JPMorgan say prices as high as $10,000.
Yeah, exactly. Jamie Dimon.
And so this is a major shift, and it sort of signals that we're probably going into the third and final phase of the bull market, which is the greatest gains in the shortest period of time, usually. The bull markets have 3 phases, and this final phase, like I said, greatest gains in the shortest period of time. Well, what are the gains that we've had so far? We've gone from 250 to 4,500 bucks an ounce. These are some huge gains already. If you look at the we created an interactive chart where we overlaid the bull market of the 70s with the bull market of today, and then there's something called Elliott wave analysis. And you take these waves. The first wave, the wave, I can't remember whether it's A, B, and C, or if it's 1, 2, and 3. 1, 2, 3, or 1, 2, 3, 4, 5. Yeah, it's either 3 or 5 waves. When we match the very bottom and that top up, it was projecting that this bull market would be 2.6 times greater in magnitude and 3.1 times longer than the 70s bull market. But it was projecting $9,000-$10,000 an ounce gold. And it's interesting to see these major banks and financial institutions, they were telling you to stay away from gold when it was 250 bucks. And now that it's $4,000, they're saying, oh, maybe you should put 20% of your part. Why? Because it's been the number 1 performing asset class of this century since the year 2000. The only thing that has outperformed precious metals is cryptos.
The continued transfer of wealth from west to east marks one of the most significant trends in the global precious metals market. While Western investors remain distracted, Eastern nations and central banks continue to accumulate physical gold and silver, securing tangible assets as their currencies weaken. Historically, the natural gold-to-silver ratio hovered around 15 to 1, reflecting the abundance of silver in the Earth's crust. Today, however, the ratio sits near 85 to 1, even soaring to 120 during the pandemic, making silver more undervalued relative to gold than ever before. A similar setup occurred in the late 1970s, when silver eventually surged higher as the public shifted from gold to the more affordable metal. With major institutions now forecasting gold between $9,000 and $10,000, we may be entering the final, most explosive phase of the current bull market. Let's get into the interview.
Central banks are still buying. It definitely has not peaked. In this last run-up, it was basically Asia and and India pushing the gold price, and it was physical demand instead of all the gambling on the commodities exchange and the LBMA. And so it's telling me that we're getting closer and closer to a crisis, and it's impossible for bubbles to just go on forever. So we're at a period of time where they are trying to kick the can down the road, but with things at the extremes that they are at right now, I'm expecting something within the next year or so. I'm actually surprised that we got through October with no big event. October is always that spooky month. It was nothing compared to the final months of 1979 and the first month of 1980. It was an insignificant move. In my book, The Great Gold and Silver Rush of the 21st Century, I quote several articles from Time magazine back then, and there was an economist from the 1800s. His last name was Giffen. I can't remember his first name right now, but he proposed that there's a certain class of goods, Giffen goods they're called, that where price-demand balances don't work. It's exactly the opposite. So as the price goes up of something, usually anything, there's less demand because people they look for a less expensive alternative. Gold and silver violate that, and we just saw that with this run-up. This run-up was largely caused by physical demand in Asia, Australia. It was interesting, in the United States, we weren't participating yet. In fact, there was a lot more sales than buys, and refiners in the United States got all. Well, I own 300 ounces of silver for every ounce of gold that I own, because I've allowed the gold-silver ratio. I don't let it dictate anything to me, but at the same time, I pay a lot of attention to numbers, and I try to keep emotion out of my investment decisions. And with the gold-silver ratio at these absolutely absurd, I mean, if you look at it, for 2,500 years, it was about 15.
Yeah.
And suddenly here we are in just the last century where we're visiting the levels of 100. So silver is just way, way undervalued. And so I believe that for every, if it's at 80, if you buy an ounce, if you buy 100 ounces of silver, you're going to be able to exchange that at 20 for 4 times more gold than you paid for, basically. The world's central banks seem to be positioning to remonetize gold. Trump, when he first took office, was let's audit Fort Knox, let's make sure the gold is there. There were all these signals that we could potentially end up on some sort of gold standard again. The problem is, with the levels of debt we have, I believe it's like $140,000 an ounce to pay off the national debt. And revaluing it to current market levels isn't going to make even a dent in the current national debt. And so it would have to be at prices far higher than that. The problem with that is it will upset the world economy so much. There's going to be some sort of giant convulsion that we go through. But in my book, The Great Gold and Silver Rush of the 21st Century, I sort of lay out we had the classical gold standard from the late 1800s until the end of World War I. And then we went on something called the gold exchange standard between the wars. And then we went on the Bretton Woods system from 1944 to 1971. And now we're on the global dollar standard. And these are vastly different monetary systems. It's not the same at all. People just don't, the common man was unaffected by these changes because they were little baby steps off of gold. So he went from something that was rock solid to a little less of that something to less to none.
The recent surge in gold prices wasn't driven by paper speculation, but by physical demand from Asia and India, a clear sign that confidence in fiat systems is fading rapidly. As central banks continue to add gold to their reserves, the West remains unaware that a monetary reset may already be underway. With the gold-silver ratio still hovering near historic extremes, silver remains deeply undervalued and positioned for explosive gains once this imbalance corrects. What's forming now feels like the setup to a significant financial event, similar to the turbulence of the late 1970s, a prelude to monetary transformation. Whether it's a formal revaluation or a market-driven repricing, the writing is on the wall. Hard assets are reclaiming their economic role. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.